Hello, and welcome to the Bitcoin Roundup podcast presented by Coinbits. We bring Bitcoin news, hot topics of conversation, and deep dives into a variety of Bitcoin topics to you weekly. We are Coinbits, a Bitcoin financial services company. Check us out at coinbits.app. This recording is for informational purposes only. No investment or legal or any other advice should be drawn from this content. And as always, consult an advisor before making any legal or financial decisions. Welcome to Bitcoin Roundup Live. We're hosted by Coinbits. Today, we're very honored to have the infamous Bear of Bitcoin Twitter, one of Jerome Powell's biggest fans, and ESG stands for Energy Shortage Guaranteed advocates, Dr. Jeff Ross. Jeff, welcome. Thank you for being so gracious to us with your time. Glad to have you with us today.
Hey, I'm really happy to be here. Thanks for the invitation. And hopefully we can have some fun up here and do a little educating, and everybody will be better off for it.
Absolutely. And education is our main goal with these sessions. So we really appreciate you taking the time. You do a really good job of breaking things down for people. That's why people love to follow you, and that's why we requested to talk with you. So, of course, for those of you who might be joining who, for some reason, don't know who Dr. Jeff Ross is, let me do as quick as I can, a quick intro here. So I think he needs no introduction, but Jeff is an interventional radiologist by training, and he's a practice doctor for many years, turned into an investment manager. He's the founder of VailshireCap Capital Management. Check them out, VailshireCap.com. One of the really impressive things I think that you've accomplished, Dr. Ross, is going at your MBA after completing all the grueling hours it takes to actually become a practicing doctor in a highly specialized field.
Hey, thanks. Yeah, I have a hard time sitting in general, so I was pretty happy to have another thing to do on my plate. I retired from medicine, just so people know, back in the fourth quarter of 2021. So about a year ago, actually. I think it was late September. And so I had a little free time on my plate, and I've always been a big fan of just, educating space in general, as well as fund management, obviously macro investment, stuff like that. So it's fun to work for basic Bitcoin and help spreading education to the mass about Bitcoin. So yeah, a lot of fun. Thanks.
Yeah, for sure. And for anybody who is joining, Dr. Jeff Ross joining us today, he's one of the brighter minds in a space. We're all the better for it, and I'm glad to have you on Team Bitcoin. There's way too many professional business accomplishments for me to try to cover in a list today, but you did have recently an interview with Natalie Brunell on her Coin Stories podcast, where you cover a lot of your personal background, and it's a really good listen. We suggest everybody here go take a listen to that. It's a really good introduction to your work, and how you view things was really awesome. So we can't wait to pick your brain on the state of the financial markets. What's going on this week is absolutely mind-boggling, and chances are it's going to only get crazier. But before we dive into all that, allow me to just do a quick disclaimer here. So Coinbits is a Bitcoin-only financial services company. Please check us out, coinbits.app. We have a great Bitcoin DCA product. We also have a great newsletter, which today's comes out in a couple hours. Our link for that is in the bio. Go subscribe. It's a free weekly newsletter to just help you keep abreast of all the information that happens at a million miles an hour in Bitcoin land these days. But anyway, Coinbits, apologize, is a financial company, and nothing that we discuss in this conversation constitutes investment, legal, tax, or any other advice. Now, Dr. Bear over here, Dr. Jeff Ross, is a financial advisor, but he's not necessarily your financial advisor, and neither are we. So this conversation is for informational purposes only, and before making any decisions, please consult an advisor. So this conversation is usually kind of driven, and we try to take as many questions as possible. If you're here and listening along and you have a burning question that you ask, please use the bottom right comments section on the Twitter Spaces dialogue, like a comment box. Put your questions in there. We'll try to ask Dr. Ross. Dr. Ross is gracious enough to kind of spend some time with us, so we'll try to get as much out of him as we can, and your questions are as good as any. So first, to kind of start us off, Dr. Ross, you've recently tweeted about a bunch about market volatility. I think a couple of days ago, the VIX was at 32, and you tweeted about that being the norm for the time being. How is this volatility that we're starting to experience and likely going to pick up going to be the normal? What does that look like in your mind?
Yeah, that's a great question. So, and volatility is really important. So one way to measure volatility is with something called the VIX, VIX. That basically measures the volatility S&P 500. There are different for measuring volatility for different indices, but that's the most commonly used one. So that's kind of what I'll be referring to if I'm talking about that. Whenever there's trouble in the financial system, kind of under the hood, whether it's covert or overt, basically overt meaning it's out in the open. A good example of something that went from covert to overt was what happened with the Bank of England yesterday, right? Where they found out that these pensioners are having some serious problems. There is risk of contagion. What happened? Bank of England stepped in heroically and bought a lot and so that brought back reminiscences of quantitative easing. The market celebrated. I think they were extremely premature in celebrating that. What that really shows is that there is serious trouble underneath the hood and primarily involving debt, the debt markets, credit markets. So bonds is kind of the general term for that. Whenever there is trouble and people start to fear that there may be significant downside, they tend to pay more for insurance. One of the ways to buy insurance on your investments in the financial world, at least, is the use of options. So what people will do is they'll buy puts. And so when the put prices start to increase more than the normal baseline level, what happens is that can be measured in these volatility products. So people are paying more and more. That means they're getting more and more scared. The volatility itself starts to rise. So we see the VIX rise. So VIX, the product of VIX generally, tends to be low in good times and high in bad times. And when it goes high, it tends to move in streaks. So you got to be careful when you start to see VIX starting to take off. It may be the start of something sort of horrific. Good examples of that, you can go back and look at what happened to the VIX during March of 2020 when we had that COVID scare. It basically just spiked and ripped higher. The VIX itself, VIX, that you could actually see in the markets in February of 2020 was sitting at 14, about 14.8. And within a month, it was all the way up to 72. So basically what that means is people got just incredibly scared for the future. People, by the way, human nature, what they do is they don't buy insurance when they don't need it. And when they start to panic and get scared, then they buy insurance. So they're buying it at the wrong time because you're buying insurance when it's expensive and not buying when it's cheap. So there's a lot of good life lessons in there. And so when you see the VIX spiking, what that really means is people are very scared. When people get scared, what do? They make stupid decisions. They tend to panic and sell. That's when we see risk assets in general do very poorly because people are like, I've already suffered losses. I think this may go to zero. I'm freaking out. I hit the sell button, sell, as Kramer would say. And then they go to cash. They go to the US dollar as their safe haven asset because they think that's better in the near term than sitting in these risk assets, which may just continue to go down. So that was a very long-winded answer. But when you see VIX spiking and we are seeing VIX go much higher than its baseline levels, that means there's trouble under the hood. It means people are scared. It means they're paying more for insurance against downside risk.
Yeah, what an amazing introduction. Thanks for taking us through that. And I think a lot of people have heard or seen VIX and haven't really considered what actually that means. So thank you for explaining that. Going back to volatility for a second, I think a lot of people have seen Weimar Republic mark to gold price from the crash of that market back then. But what people often don't see is the monthly volatility, right, of the price of gold and price and marks. And it's like literally just a graph going up and down. Are we starting to see our version of the monthly gold price in Weimar marks? Is that what's starting here? Is it going to be a muted version of it, or can it get that bad again?
So it depends. First of all, it really depends what currency we're talking about. I assume when you're saying that, you're asking about the US dollar.
Yeah.
Yeah. So the US dollar, for all of its problems and for all of how often I make fun of it and talk about all of its negative effects, it's still the strongest currency by far in the world. So the dollar is going to be with us much longer than lots of other currencies are. Now, could we have a Weimar Germany type event in other countries? Absolutely. So basically what that means is when you get to the final stages of a fiat currency, and by the way, for people in the audience, all fiat currencies go to zero over time. They all die. That's something to remember. They're just a phase of their life cycle, but they're trending towards zero value over time. So that's why you don't want to store your value, your hard-earned purchasing power in fiat cash, because if you do that, you will lose your purchasing power over time. It's basically a mathematical guarantee. So that's the point. Are we seeing that in the dollar? No, not yet. But we are seeing the tremblings of the final days of the fiat system. Now the dollar is king, right? And so, but what about all of these other currencies? What about, the pound, and what about the euro? What about the Japanese yen? What about currencies in other countries, any like emerging market countries? those currencies have severe fluctuations and they have severe volatility like most of us in the US have never seen, or we almost can't even believe that kind of volatility. That's why those, by the way, people in those nations that deal with a rapidly debasing or rapidly inflating currency, they just get Bitcoin. It just makes sense to them, right? They think, why would I keep my money in this crappy government currency when I could put it into a much more stable store of value over time, which with a completely knowable monetary policy, which doesn't have crony capitalists at the top of it trying to steal my purchasing power, or politicians, that's another word for them, trying to take my purchasing power through taxation, through monetary debasement. Why wouldn't I just put it into Bitcoin? And it makes much more sense to them. Here in the US, most people view Bitcoin just as a speculative asset, some random commodity or, a little tech stock or crypto, God forbid. It's very different than that, as hopefully most people in the audience know. So are we seeing that? I'm doing a really long roundabout answer. Are we seeing that? Not yet in the US, although we will see definite volatility during this recessionary period. So as we're headed into a recession, and we clearly are, and it's not just the US, it's around the world. Most of the entire world's economies are headed into a recession. And on top of that, because inflation is high, central banks around the world are doing these tightening policies. They're doing the tightening policies, they say, until inflation is defeated, because they want to destroy demand and bring inflation down. But they're also doing this after we just hit the peak of an everything bubble in asset classes, basically in the fourth quarter of 2021. So the valuations of assets, whether it's real estate or stocks or bonds, were at literal all-time highs. Like they haven't ever been higher based on several different metrics. Whenever that happens and they become overstretched to the upside, they have to do this reversion to the mean at some point, and they start to fall. And so now we're in that period. We've actually, if anyone, has been paying any attention to what's going on in the world, you'll know that stocks, bonds, and real estate have all taken a dive basically throughout all of 2022. We're just starting to skim off the excess right now. And I think we have a long ways to go before we get close to a bottom and start again and start the next bull market. So very long-winded answer, but yes, expect during these tumultuous periods to see severe volatility. Also, during the end stages of different government fiat currencies, you see massive volatility. You see hyperinflation, which is, I think, defined as 50% inflation month over month. It's crazy. It's definitely not what we're seeing here in the US. We're seeing high inflation, but it's nowhere near hyperinflation. Some other developing nations deal with hyperinflation, and I think we're going to see many deal with hyperinflation in the coming 6 to 9 months. As the dollar gets stronger, their currencies get relatively weaker. Gets harder and harder for them to pay back US denominated debt. They're also heading into recessions. They're in a world of hurt. We're going to see hyperinflation in some of these other countries, but not here in the US.
Yeah, it's a really interesting perspective. We were chatting with Greg Foss about this last week, and I'm going to get your perspective on the same question that I asked him as well. You touched on this a little bit already with things starting to break down in specific countries outside of this. And I think that the writing has been on the wall for this to happen for quite some time. I mean, I think macro commentators, yourself included, Greg Foss, many other Bitcoiners, expected things to start to break down in Europe. We never expected it to happen this quick. We definitely didn't expect it to be England, as one of the first ones to show some signs of cracking here. Kind of came out of nowhere, even to those who have been forecasting and calling for this to happen at some point. Like the news that came out with the Bank of England, they're doing is, correct me if I'm wrong, is what amounts to yield curve control by buying those long-dated bonds and trying to save the pension funds there. So the question I have for you is, as quickly as things are starting to funnel outside of the US, in a country as a stable an economy as England's is, do you think that the Fed governors and policymakers here in the US are taking note of kind of what happened yesterday? And can they be dumb enough to ignore it and not let the thought of what's happening there seemingly out of nowhere, even to those who saw it coming, affect their policy decisions and decision making here in the US?
I think they are absolutely paying attention to what's going on. And they realize basically anybody who understands the credit markets understands that things are getting ugly. Like there are a lot of reminiscences right now of like kind of 2008-ish times, kind of early 2008, where, a lot of equities investors, and Foss talks about this a lot of stock investors, they honestly just have no idea what really is going on. They think, oh, no, stocks came down, they're cheap. Kramer says, buy, I'm going to buy. But what the real people who are, I would say, like extremely intelligent about what's going on are in the credit markets, and they see serious issues going on in the credit markets. I guarantee right now that All of the world central banks are paying attention to what the Bank of England did. I believe they are talking to each other behind the scenes. What do we do? Like, what was this an appropriate step? Was it enough? Was it too little? Blah, blah, blah. And then related to that, by the way, I also think that investment banks and commercial banks all around the world are also looking at their own balance sheets. It was a wake-up call last week. It had sort of whispers of a Lehman type event when Credit Suisse announced formally, publicly, that they're trying to build their cash position. Why would they do that? That's because they're having trouble, right? As a business, they're struggling. And all of the assets that they have on their balance sheet have been markedly repriced lower. So the assets that they thought they had, the valuation that they thought they had, is actually significantly lower than what was on their books. As it writes that stuff down, then people who they owe money to, right, who they're doing business with, says, you know what, we don't really like those things that you have on your balance sheet. We would prefer much more pristine assets. Do you have any short-term U.S. treasuries maybe? How about just cash? Do you have U.S. dollars? And so that's what they wanted. They want to see that on their balance sheet in order to continue doing business with them in good faith. So I bring that up to say, I think investment banks around the world, US here as well, but primarily in Europe, are seeing like, how much exposure do we have to Credit Suisse? What about Deutsche Bank? What about these other huge banks that are showing warning signs that things are getting ugly out there? And so you have to be very concerned about the risk of contagion. For those of us in the Bitcoin space who are maybe familiar with crypto, we all know very well what happened. Like, I don't care at all about Terra Luna, don't use it, never have. But I was warning people that this is literally going to melt down if we go into a bear market. It's a system that works, their whole concept of the decentralized stablecoin. It only works when the markets are stable or going higher. It does not work during a bear market. And I got a lot of flack for warning people about that. But then when it collapsed, it happened really fast, right? Went from, 100% valuation to zero in just a few days. And what happened to Bitcoiners? Bitcoin got sucked down dramatically. Why? Not because it necessarily had anything to do with that, but because Bitcoin is pristine collateral that's available 24/7, 365. And so when people get margin called, and margin calls aren't really a familiar concept to most people, like most retail investors like us, but for people on Wall Street, for businesses, for commercial banks, and all these larger institutions, they're a regular part of life. Margin call means if you're borrowing any money to own some products and that the valuation of that asset goes down precisely, you get margin called, meaning you have to inject new cash into that system, or they liquidate you. And so what people do is they sell whatever is available. And for a lot of people, if they have Bitcoin on their balance sheet, they sell that quickly. A good example of what's not like Bitcoin is real estate. Real estate can be a great store of value, but it moves very slowly. You can't just quickly sell your real estate in 3 hours, right? You need to take time to do that, weeks, maybe months for the transactions to go through. Or gets liquid, or whatever is the most liquid tends to get liquidated the most quickly. That sucked down Bitcoin. So anyways, again, another really long roundabout answer. Yes, banks are paying attention. Yes, central banks are paying attention. I would expect more and more of this to make the news in the coming weeks and months. I really think that it's possible that in the next quarter or two, so fourth quarter or Q1 of 2023, things are really going to get bad. Like I think we're just getting to the ugly parts now. It's sort of like the tremors before the major earthquake. Things look ugly. And so we're going to start seeing more and more actions like this. And then we're going to see some huge event, like a Lehman Brothers type moment where something goes down and it goes down hard. And then we're all going to be talking about contagion in the traditional financial system. And that's when things get kind of scary.
Yeah. And many are calling, it seems the past couple of days, many are calling the Bank of England moment was the Lehman moment of this global debt crisis that we're entering now. But I want to bring it back to Europe for just maybe one more question here. So, Europe's central bank is laughably behind the 8 ball here with their rate hikes. I mean, I think their last rate hike was bringing interest rates back up to 0% with double-digit inflation in the majority of the European Union. So some would even venture to say that what they're doing is textbook financial repression, and purposefully doing that. And those who don't know, financial repression is essentially when you intentionally keep interest rates low and let inflation run high as a way for sovereign debt to pay off, right? So you're paying off debt with essentially cheaper currency. And there's many articles written about this, the IMF in the World Bank's playbook, and how to deal with high inflation. But if the Fed, right, and they'll say many are saying going to be after this next hike coincidentally, or perhaps not so coincidentally, to align with, election season here. If the Fed were to pivot and to start to cut interest rates, or to even put out the tea leaves that they're going to start to think about pivoting, where does that leave Europe? I'm asking because the dollar has been running super parabolic, right? And so do we get in that case where the pivot comes, the dollar starts to weaken, other currencies, the euro being one of them, start to make parabolic runs against, the dollar? Foss indicated last week that might be good for Europe, especially with their energy situation, right? So energy by and large right now is currently denominated in USD. And so if the euro starts to strengthen against USD, that might be good for Europe, at least in the short term. How does that foreign currency exchange, Dixie versus the rest of the world situation play out?
Yeah. So I guess I have a bit of a different opinion or view of what's going to happen. I think that we're actually going to see continued dollar strength for the next several quarters, and we may even see it for the next several years. I think the Federal Reserve will be the last to blink and revert back to quantitative easing tactics. Personally, I think we're going to see all of these one by one. So Japan is Japan is full in yield curve control and QE, right? So they're just like you described. They have a huge, massive mountain of debt that they'll never possibly be able to pay back. So what do? Instead of defaulting on it outright, they debase their currency basically and pay it back in less cents. They can get away with that by doing something called yield curve control. So they basically monetize their own debt. So the Japanese central bank buys their nation's own debt, which is kind of crazy if you think about it, right? Imagine having a credit card and you just sort of assume that debt and pay it back with pretend money. That's what Japan is doing. And so I think one by one, other nations around the world are going to do that. And the dollar is just going to continue to get stronger and stronger. People who are familiar with kind of the dollar milkshake theory, I think that's actually happening right now in real time. And I think it's going to continue happening. So basically the dollar will get stronger and stronger. I think we continue to maintain higher rates, meaning that our treasuries are more desirable to other participants around the world. So two things happen. One is that people, if they have US denominated debt, they have to have more and more of their currency to pay back the stronger dollar denominated debt. So that monetary flow flows back, dollars flow back into the United States. And then on top of it, people want to buy treasuries. So they convert their currency to buy US treasuries. That also strengthens the dollar and weakens their currencies. So we're going to see more and more of the world's purchasing power deplete at their expense and then to the benefit of the US dollar. I actually think if you look back in history, this is exactly what happened in the US in the early 1980s, basically from 81 to 85. We're at dollars. The Dixie right now, I haven't checked it today. It's probably like 113 or something like that. I mean, just so I know what I'm talking about. Yeah, it's 112, so it's down a little bit. This is about the same level where it was back in 1981. And then what happened is instead of going down, it continued to go higher for 4 more years to 1985. It got up to a level of about 164. And then what happened at that point is it was literally causing so much damage. It was such a wrecking ball to the rest of the world that they had to do something called the Plaza Accord. World leaders met and they basically figured out a way to force the dollar lower and cause these other currencies to rise up. There's all of these causes and effects for people who understand economics, right? If you have a strong dollar, that's really good in some ways. It's good if you're a consumer, if you're a US consumer. It's bad if you're a US business with lots of international operations because you just can't sell your products as well overseas because your products are just relatively more expensive now. However, if you're a weaker currency like Japan, and I think they're trying to do this on purpose to sort of jumpstart their export business, your manufacturing business can really do really well because you can make great products and sell them for relatively much more cheap to the US dollar. If you remember, most people in this room probably aren't old enough. I am. Remember the 80s pretty well. That's when Japan was in its heyday for its car making, right? Honda, Toyota, Nissan, they all just were crushing US competition, the big three in Detroit, because they could make really good cars and sell them for, the same price or significantly less than US models. And so that was fantastic for their manufacturing base. It was fantastic actually for their economy. So there are pros and cons to having strong and weak currencies. I'm sort of the opinion that where the dollar continue to rise, it'll do it in fits and starts, but I think it continues to rise for a few years. And that will give the US a lot of geopolitical power, unfortunately at the expense of emerging market economies and as well as developed economies.
Yeah, you're very bearish. You're Dr. Bear for a reason. It's hard to imagine. It's only been, not even all of 2022 at this point, and the Fed hasn't even started actual quantitative tightening yet. They haven't started to really unroll their balance sheet. So it's hard to, and things are already breaking in Europe and elsewhere. But it's hard to imagine that this can continue for, for a few years without things getting significantly worse. And, obviously the Fed's mandate is to the US, but with a global economy as intertwined and as leveraged as it is globally, I don't know. A few years sounds like a bit too long for things to continue that way without significantly getting worse. But, we'll see. I think that where I'd like to kind of pivot to next, and I think this idea of yield curve control, which won't be called that in the US, it'll be called something else. Yesterday, I think it was yesterday, correct me if I'm wrong, but Bitcoin Magazine Pro released an article titled The Bitcoiner's Guide to Yield Curve Control and the Fiat Endgame, which is what you started to allude to a little bit there, Dr. Ross. Can you maybe kind of run us through the highlights, perhaps for people who are unfamiliar with the topic, which we actually did a thread on not too long ago. I'll find the thread and nest it here. But for those who are unfamiliar with the idea of yield curve control, you've alluded to it a little bit already, but what does that actually mean for people who are maybe hearing it for the first time? What does that look like from a Bitcoin lens to you?
Yeah, so countries can do it for different reasons. I think the primary reason, especially these days, is when countries are too over indebted, meaning their debt pile gets too big. They really do not want interest rates to rise. They don't want the rates on the bonds that they have put out to get higher, because it makes it harder and harder for them to pay back those rates, basically. So the higher the rate, that should make sense to most people, right? It's sort of like most of us understand mortgages. It's easier to pay back a 3% mortgage than it is to pay back a 6% mortgage. Your monthly payments are just significantly lower at lower interest rates. So when you have a nation like Japan, I think that has 220 some percent debt to GDP currently, there's no possible way they can pay that debt back in sound money. And so as interest rates start to rise, it basically pushes them to sort of a short-term breaking point where it's like, you know what, we can't do this anymore. So what can the government do? It comes out and says, what we're going to do as the Japanese central bank, what we'll do is we'll monetize that debt, meaning we will basically create new money. We'll buy that debt from the Japanese government and we'll maintain a rate. So yield curve control, that concept is used. We'll fix a rate that right now they're fixing, I think it's their 10-year, they're fixing their 10-year note bond at 0.25%. If the bond rate tries to go above 0.25%, they jump in and they buy a bunch of those bonds. Buying bonds. So that means that as the prices go up, that causes upward price pressure. And the way bonds work, that means it's a downward pressure on the yield. Those are like a teeter-totter. So bond yields and prices are inversely related to each other. The higher the price, the lower the yield. The lower the price, the higher the yield. And so that's what they're doing right now. They're buying those bonds to keep the yield down to that certain level. Now, that all sounds kind of good and it sounds kind of handy, right? Like, sweet. Like, if we can just buy our own debt and pay it off, why wouldn't more countries do that? The downside and the drawback of that is what's happening is their currency, as they create more and more currency, that's driving the value of each individual currency unit. In this case, the Japanese yen, it's driving it down towards zero, debasing the currency. It's causing the value of the currency to go down. Why is that important? If you're a Japanese citizen and you have your life savings in Japanese yen sitting in a bank somewhere in Japan, the purchasing power of your money is going rapidly lower. That means what you could afford this year with a certain amount of yen, you can afford much less a year from now in that same amount of yen. So that's unfortunate. So basically it's government survival on the backs of the purchasing power of its own citizens. This has been in the playbook since post-World War II United States. Actually, the US did this really successfully after World War II. After World War II, we had massive amounts of debt. And we basically did yield curve control, kept interest rates low and let inflation run hot, just like you were talking about. And so what happened? We were able to pay that debt back in much less sound money on the backs of the purchasing power of Americans. Americans couldn't really do anything about it. And I'll tell you, it was different then because we had just basically come out of World War II relatively unscathed. We were kind of considered heroes. And we were the primary beneficiaries of this new world economy, right? Because our country was still Europe was decimated. So it was kind of okay. It was sold to Americans you know what? We have this debt, but it was for a good cause. Let's take it in the chin. Let's be okay with losing our purchasing power. And we're going to get this debt paid off and we're going to have a better America tomorrow for our kids and grandkids, right?
Right. We were net, sorry to interrupt you. We were net producers at the time, right? America was
exactly
still exporting. opposed to importing. Okay, sorry. Say.
Absolutely, absolutely. And then the other very interesting piece here that most people don't think about. We didn't have, and I say we, back then didn't have the option to opt out of that. They had to participate in that because all of them just had their US dollars, right? What couldn't they do? They couldn't own gold. Gold ownership was literally illegal back then. You'd get thrown into jail if you were caught owning gold and you would get fined. And then also, obviously, Bitcoin didn't exist. So there were no alternatives to the financial system for Americans unless they got super creative with other things. This time around, it's different. So this time, the US and other nations have massive amounts of unpayable debt. They're trying to use that financial suppression or repression model like they did back post-World War II, Japan doing that already. Why doesn't it work as well this time? Because this time we have way more options. You can still opt out with gold if you want. I used to be a gold bug. I'm not anymore because I discovered Bitcoin. Or you can opt out with Bitcoin, which is literally just a parallel financial and monetary system. When you have those kind of options and people are realizing that the continued bag holders of the US dollar, that they're going to rapidly lose their purchasing power over time, just like what's happening in Japan, like what's going to happen in England, they can opt out. And what that means for the government fiat currency is people start to want it less and less. They don't want to hold on to the government currency as much. People can start to lose confidence in that currency. They start to do things like call central bankers jokers. They start to say, like, we're living in a clown world. Why would I continue to hold this government fiat currency if they can just debase it actively right in front of our eyes and have these other options like gold or much better coin, in my opinion? So that's the situation we're in currently. I think this time around it's going to lead to the collapse of multiple government fiat currencies. Again, I don't think it's going to happen to the US dollar, but I do think it's going to happen to a lot of emerging markets and possibly some developed nation currencies this time around as well.
Yeah, that's a really interesting perspective. I tend to agree with most of that. I think that, let me take a question here from the comments because I think that will answer the question that I wanted to ask you as a follow-up. So Ben Herring, I'm not sure, Ben, if you're still with us, but he asks here about a tweet that James Lavish put out about 30 minutes ago as we were starting. So saying, Jeff, could you lend your opinion on how these high spreads come about and what it means while they're all high? And he's talking about credit default swap spreads, which James just sent out a tweet about not too long ago. I'm going to nest it in here so that you could see it. But credit default swap is basically insurance on sovereign default, isn't it?
Yeah, credit default swaps are basically insurance on any kind of debt. So it can be corporate debt or it can be sovereign debt as well. And so lots of people, again, you know how this all relates back to the credit market. What people are doing is they're watching insurance rates. Remember what we talked about earlier, like talking about volatility? When people are scared, they start thinking about buying insurance. They do it at exactly the wrong time. You should buy insurance when everything is great, when it's cheap. But instead, people start to panic. They get scared. They start to bid up the price of insurance. So credit default swaps, whether they're on a sovereign nation or they're on a corporate bond, are basically just default insurance against those bonds. So as the rates of credit default swaps increase, that means that people are getting more and more scared that this debt is not going to be paid back in sound money. So we see that now. And this is where you start, Warren Buffett's famous quote, it's when the tide goes out that you see who's been swimming naked. So the tide is starting to go out. Liquidity is contracting throughout the world. We're headed into a major recession. What countries have been swimming naked? Which credit default swap rates are rising? All of them are rising. The ones that are the weakest are going to rise the highest and the fastest. That means people are very scared that these debts are not going to be paid back. So we're seeing that happen. We're seeing in the pigs, right? So, Portugal, Italy, Greece, those are kind of the known ones. We're even seeing a rise in the US and Canada. It's rising just across the world because people are concerned that the debt market is starting to get problematic. We're seeing it in corporations, investment banks, Deutsche Bank, Credit Suisse, other banks are starting to go higher. Again, that's because people are concerned that they're going to default on their debt, or there's a higher risk that they're going to default on their debt. So that's another thing just to watch. We still haven't reached crisis levels yet, by the way, in a lot of those markers, but they're trending in that direction. That's what I watch. Where is the world trending right now? The world is trending from basically every kind of credit-based marker that I follow. It's trending higher and in a negative way. It's not the direction you want to see things. It's just like you don't want to see volatility rising. Volatility is rising. Premiums on puts are rising. Credit default swaps are rising. We haven't hit crisis level yet, but it suggests that we may be getting to the point where we could reach a crisis and have some sort of contagion effect.
Yeah, and I wanted to tie that a little bit to yield curve control. So just to play devil's advocate here for a second, and maybe this will tease out some of the questions that people have on their minds if they're hearing this for the first time or if they're a bit confused about it. So we said yield curve control a way to cap yield curves at a specific target rates, and Japan has essentially been doing this for years now. It's going on 7 years here. I think 2016 is when they started. Just quickly scrolling here through the Bitcoin Magazine Pro article that you had shared yesterday. Yeah, it looks like in 2016 they targeted a 0% on their 10-year bond, and now it's 0.25%, which is laughable, right? That's that's like money has no cost. But anyway, the idea here is that if we look at Japan, right, and then someone who's kind of hearing this for the first time might say, well, hold on, this is a really good setup. And Japan is not some kind of third world country. It's a very pleasant place to live. They have relatively a large economy that's intact, nothing that's fallen apart, and they've been doing this for years. And so maybe they're weakening their currency, maybe their purchasing power is slowly decaying over time, and maybe this yield curve control strategy is going to fail eventually, but it hasn't yet. And so for people who might say, what's wrong with it? It looks like it's working out okay, and it kicks the can down the road enough for someone else to deal with the problem. As I don't know if you saw this or not, but yesterday, Drucken Miller had a conversation with, I forget who was one of the talking heads at CNBC, and basically was like, it won't be a problem for us, talking about Social Security and other entitlement benefit. It'll be the problem for whoever has to deal with it at that time. Will be okay, kind of thing. But what would you say to someone like that who's maybe saying, okay, like yield curve control has been tried and it seems to be working okay, and if it comes to that in the US, no big deal. We could kick the can down the road some more and things will continue to play out the way that they have been for the past 20 plus years. Thoughts?
Yeah. So basically what yield curve control does is it extends the life of a credit-based economy for a little longer. So like to your point, it is kicking the can down the road, meaning that it's pushing its problems down the road and staying alive for another day. I like it. Two examples for regular people, if it's still kind of hard for you to understand. One is that imagine being, you're dirt poor, you can barely pay your bills. So you max out your credit card. You're not making enough money to pay off your credit card. So what do? You go out and apply for a second credit card. And now you get that credit card. And now you have money, you can survive for a little bit longer, but then you max out the limits on that credit card for which you're paying off your first credit card. And now you've maxed that one out as well. And so then you go out and you get a third credit card, right? At some point, people don't give you credit cards anymore, and they don't want your business. And so that's kind of what it's like. It's not a good thing, but it does extend your life. It just shows how weak the Japanese economy is. They're basically, and I hate to say it, but kind of like a zombie nation right now. Their economy is dead. One other example, because I'm a former doctor, it's like being brain dead, but being in the ICU, staying alive. Your body is kept alive on life support. So you have a tube down your throat that's helping you breathe. You have IV in, people are managing your electrolytes, doing all this kind of stuff for you. You're technically alive, but you're kind of dead too. And that's sort of what Japan is right now. It has so much debt that there's just no possible way it can grow out of it anymore at this point. And yield curve control just helps to keep it alive. It's basically life support to keep it alive for another year or 2 years, or who knows. At some point, the charade comes down. At some point, all of the end of these Keynesian economic experiments that we're going through right now across the world, Japan is leading the way, but we're going to see it in Europe as well. England's dealing with it now. The US is doing it too, but we have a unique circumstance because we have the world reserve currency still. But that's the fate of all of these countries. When you live on this system, it's too tempting to accumulate that much debt and to continue to kick the can down the road to stay on life support. Politicians don't want to deal with that. Who's going to be the politician to say, we actually really need to fix this and we need to do extreme austerity and we need to have sound currency? Nobody. There's no way that they will do that because it's way too politically unpopular. And so they'll just continue to kick the can. And then at some point, it all just comes crumbling down together. And I think that will happen in our lifetimes. And we'll have to have an alternative system at that point, some kind of the financial and monetary system. We're not there yet, but we're going to start seeing some victims here, in the weaker economies in the coming years.
Yeah, and we've been saying the weaker economies for quite some time. I wouldn't say England is a weak economy, but all of a sudden they're having to save their pension system. And we're going to wake up one day and it's going to be multiple of these countries. It feels like that would, as predictable as that is, that will be surprising too. So for people who have joined us here recently, welcome everybody. Thank you for joining us. If you have questions for Dr. Bear, Dr. Jeff Ross, who's joining us here today, shares perspective on the markets in general and how they pertain to Bitcoin, please feel free to throw in any questions you might have in the bottom right section here with comments, and we'll try to get through as many of those as we possibly can in the time that we have. Dr. Ross. Joe, you had a question you wanted to bring up?
Yeah. Hi, Dr. Jeff. Thanks for this. This is fantastic. I just had a question kind of overall on the Fed and their plan. They're kind of their long game. Obviously, they say at least that they're solely focused on inflation and bringing that down. But we see this week with the Bank of England, what the Fed hiking interest rates can do to the world economy and other global economies that are kind of rely on the United States being the global reserve currency. So how does that kind of play into their long-term decision-making? Is it all about inflation? Is it all about domestic inflation? And I guess, what are the consequences on a global basis? Like, does the U.S. become vulnerable with our global relations if we continue this route? Can we focus solely on inflation if we say we want to without there being any consequences of that, as we kind of saw already play out this week?
Yeah, thanks, Joe. Great question. So a lot of different talking points there. I'll kind of hit the final part of your question first. What does that mean? Like, what are the repercussions when inflation is running hot and we're maintaining higher interest rates through central bank policies? And then we start seeing what happened with the Bank of England, right? Where they're starting to monetize debt again and doing what, sort of QE, like half of QE. That to me is what stagflation is. That guarantees basically where the world is headed into stagflation. What does that mean? It means that inflation continues to run hot and interest rates are kind of tracking these higher levels of inflation. I think they can continue to stay high for a while. I think inflation is going to be a problem, by the way. That's not just going to go away. I definitely think this is going to be a decade of higher inflation, higher interest rates, and basically very low economic growth. So the first part of stagflation means stagnant growth. So we're going to see the world economy that was doing okay, that we kind of peaked in the late 90s or 2000, and we got hammered back. We were trying to grow again. Then the global financial crisis came. This is the problem when you financialize a country instead of growing based on productivity. The growth that we've seen, especially in the markets, is basically pure financialization. So we've been growing faster financially than we've been growing kind of based on our underlying productivity. Now the bills are coming due, and unfortunately, it's getting harder and harder to kick the can down the road. So I actually think we're going to see most countries doing kind of what the Bank of England was forced to do, and I think eventually the Fed will capitulate and do this as well. We're going to see basically persistently high inflation that's going to be frustrating for everybody. I don't think it's necessarily as high as it is right now. We're going to see it kind of come down a bit, but it's still going to be annoyingly high. Rates will continue to be necessarily about that high or somewhere in that range, and growth is going to be very slow. So what does that mean? Getting back to our concepts of life support and brain death, right? And zombies, we're turning into a world of zombie nations, basically, where growth is going to be extremely low until we somehow get out from under this massive debt load. I personally don't really see a way out, not based on the current fiat system. I think that there's another way out called Bitcoin, but the world is not going to go willingly into that new system. I think it's going to go reluctantly with lots of fits and starts, and it's going to go down. It's not going to go down. The fiat system is not going to go down without a fight. So we're going to continue to see politicians and central banks and all the primary beneficiaries of the current fiat system. They're going to do everything they can to maintain it and to keep the party going for as long as possible until it basically collapses in on itself.
That's a really, really thoughtful answer. And stagflation historically has not been a one-time or one quick fix or one quick action away from being takes work to get out of it, at least historically speaking. Dr. Ross, one question that came in that I think is a really interesting one from, I'm going to butcher this name, Eon Leaf. In the comments here, he says, or she, is there any theoretical possibility where the current debt system could be graciously forgiven, everything be settled behind closed doors by our overlords? I guess that's really the central banks or other powerful entities, and that the fiat system simply be reset to zero for another 50 years of hell. Is that, to add to this person's question, is that possible with central bank digital currencies where, the pivot is to CBDCs, and here we go with, we owe this, with the Keynesian mindset of we owe this debt to ourselves, and so we simply erase it, and we're back to square one with this new CBDC. Forget any old instruments that you have, the new money now, CBDCs, and all is forgiven, all is well. Let's start over from scratch. Is that a possibility?
Yeah. So two thoughts on that. First of all, I think there's going to be increasing calls for stuff like that. And we've already seen that with the student loan, forgiveness that Biden pushed through. You can do little tiny bits of that and get away with it, but you can't do that on a grand scale, because that's literally what the entire credit-based fiat system is based upon, is the laws and regulations around how credit works, how loans work, paying back loans in good faith. If you just kind of try to erase that system, it would just be literally a worldwide catastrophe. And it would put the world into just absolute chaos, for sure. What would happen on the other side, I'm not sure, but it wouldn't be good. Like, I literally think it would lead to massive wars, uprisings, coups, everything, and it would not be a good result. So it's not a reasonable way to get out of them. Like I said, I still think that we're going to see calls for this, and I think that the governing officials are going to sort of push it as much as they can to see what people and what the system rate as far as debt forgiveness goes. But there's just no way to really do that on a grand scale. So again, that will, by the way, this will happen, but it won't be because we just kind of want it to happen in an orderly fashion. What's going to happen is basically we're going to see the world sort of default. This happens during massive world wars, is basically this just unpayable debt in order to try to win these wars, and people owe people, and they threaten each other, and they come to violence. And eventually what happens is you just have a massive global reset, like what happened at the end of World War II. And then we started a whole new financial world order with America as the linchpin in the new system, and the US dollar is the linchpin. I think we're getting due for that again. I'm not saying we have to have a war, but it's kind of hard to envision an outcome where we don't have just serious geopolitical tensions and consequences. So I think a war is probably the most likely outcome to reset this system, unfortunately.
Yeah, historically, that's the unfortunate way that global monetary resets have happened. To pivot the conversation here a little bit, to be more forward-looking in terms of what could potentially happen here to turn you back into Dr. Bull. Summertime Dr. Bull was a fun follow on Twitter. What do you think happens here that would change your perspective from being bearish on equities, Bitcoin, everything else, to turning bullish? And I'll actually break this apart. Do you think Bitcoin, do you think that they happen on different timescales? Do you think Bitcoin may have bottomed out, and it's, as you mentioned before, is the most liquid asset that there is, and essentially serves as a liquidity measure for the entire global system? Do you think that turns bullish first? Does it lead equities? It seems like it has been. Do they go together? Does equities lead? You've made comments on the NASDAQ composite hitting 8K, which is an interesting level. Will it go that low? Can it go lower? What changes your mind? What changes your perspective? What pivots you from being bear to becoming a bull?
Yeah, great questions. First of all, I just want to sincerely apologize to everybody for being so bearish. I've literally been bearish since January, and it's just gotten worse as the year has gone on. And it's just because the stuff I look at just continues to get worse and worse. The macro data looks just absolutely horrific. So I thought I was really bearish like 3 months ago. Now I'm just like obnoxiously bearish, and I don't want to be. I'm actually naturally an optimist, but I also am a realist, and I can't not talk about what I think is true. And I like to try to help people. And I don't do this to scare people. A lot of people think I do this, by the way, because I want to like incite fear, FUD into the markets. I really don't. Like, I'm just trying to help people to keep your eyes open and be aware of what's going on around the world. And this is, I think we're kind of in kind of a 2008 kind of moment. Like, things are bad. Markets are kind of, looking wobbly a little bit, looking toppy. And had you prepared for that, had people been ready and just been sitting in cash and didn't have, multiple mortgages and have all their money, the rest of their money in stocks and things like that, they wouldn't have gotten so wrecked, and it wouldn't have been as catastrophic. So I just want as many people as possible to kind of be aware of what's going on and just maybe take some precautions. Like, it doesn't kill you. It wouldn't kill anybody to raise cash a little bit. Maybe if you're 100% invested, maybe be 80% invested or something and have 20% cash. Anyway, so that's my disclaimer. I'm very sorry. I can't wait to be bullish again. Just so you guys know too, a year ago, people were on my case, just on my butt all the time about being a permabull. And I'm like, I'm a permabull as long as the markets tell me to be a permabull. But when they turn bearish, I'll turn bearish too. So anyways, someday I'll get bullish again. What will that happen? What will be the indicators? To your point, Bitcoin is the world's freest market. It's basically the only market I think that's left that's not being, manipulated, somehow centrally controlled by lots of different external forces. So yes, it tends to sniff out changes in economic conditions sooner than any other markets. The only close competitors are actually, believe it or not, smaller tech stocks, but especially small businesses. So you can watch what happens to like small cap stocks. What are American businesses doing? They're right there on the streets. They know the American consumer. They feel the effects of me, so they're a good indicator. I just think Bitcoin is a little bit faster and will continue to be kind of the canary in the coal mine. So I expect Bitcoin to bottom first. I think you also asked, did it bottom already? I don't think so. I think Bitcoin at best is going to kind of trade choppy sideways for a while, but I think equities have much further to fall. You brought this up that I said, and I've been kind of, openly bearish about this too. I think NASDAQ is going down to 8,000. It's a little below 11,000 today. Why did I pick 8,000? Because it peaked at about 16,000. And I think it at least gets cut in half before this is all over with. So in my books, it's about halfway there. I tell people that when it hits 8,000, I got laughed at a lot when I said this, but it's getting closer and closer. And I'm just telling you, before this is over, I think it will go below 8,000. So S&P 500 also will probably drop about 50%. I could see the NASDAQ going down 60 or 70% just because it was so overvalued. It was more overvalued, by the way, in fourth quarter of 2021, much more overvalued from like a price to sales metric and other metrics that you can look at for valuations, more overvalued than it was at the peak of the dot-com boom. And that should tell you something. So it has a long ways to fall, I think, still before this is over. When will I switch to bullish? Honestly, I just use momentum indicators. I'm pretty simple-minded. I have all of my theories of what's going to happen, but what drives my investment decisions for myself, my family, and for my clients in VailshireCap is I just use momentum indicators. So these are all still in strongly bearish downtrends. S&P 500, NASDAQ is very strongly bearish. Bitcoin, unfortunately, is still very strongly bearish. At some point, that will bottom and it will flip bullish. I don't know when it's going to happen. Right now, I have it targeted for probably March or April of 2023, that I think that the risk assets in general will bottom, and Bitcoin may front run that a little bit because it's not a true risk asset, as we know. It just trades like one. But so that's what I'm looking at. But if I'm wrong, my system will tell me I'm wrong. Momentum, it may happen sooner and it may happen much later. I have no idea, but that's when I'll flip bullish. And I promise you, and I tell people this all the time, I have in my title, it says what, Dr. Jeff Ross, AKA Dr. Bear. I'll switch it over to Dr. Bull when I'm bullish again, and I won't keep it a secret. I like to be open source with my ideas because it keeps a check on them to see if people will tell me if I'm crazy or not. And it's also a good contrarian indicator. Like I'll probably turn bullish when most people are still wildly bearish at that point, just because that's how kind of I operate. But I still think we have many months to go and much lower equity valuations to go before we do flip bullish again.
We love you for it. It's nice. It's breath of fresh air. There's many analysts, many people who look at markets and will be non-committal about timelines and about price targets. And you've given us both. So it's the very brave thing to do. I'm sure you get a lot of flack for it, but we definitely appreciate you for it. It's an interesting take. And I think someone who has historically agreed with you, at least in the past couple of years, Preston Pish. And earlier today, he, I think in response to Greg Foss, had mentioned he's been in the boat that you are in. Basically, Preston Pish the Bear as well. And he's generally seen eye to eye on you on many things that you guys discussed. And he's been sitting on cash as well. And of course, he's got his Bitcoin stack, which he's not touching. But he just today apparently deployed 15% of his cash reserves. I'll find the tweet and put it. But, this topic of Bitcoin bottoming, hasn't bottomed, hasn't not, has been a really interesting one. And there's really a case to be made for both sides of that coin. Yeah, I guess time will tell. But if your estimate of March, April 2023. I mean, we're less than 6 months away from that, 6 months at best. And things can get a lot worse, but it's hard to imagine that Bitcoin goes much lower, especially that we've had. It started with a broader crypto downfall. And then we had all kinds of, liquidations and involuntary liquidations, I would say. And then we've had minor capitulation. I don't know if you prescribe personally, Dr. Ross, to a lot of the on-chain metrics, and there's, pros and cons to their data point. They are what they are. But by all indications, it seems that the data is pointing to a major capitulation event having already happened middle of July. Could we go lower? We'll find out. But it's definitely interesting to see your thoughts on that. And then you're bearish on Bitcoin. You think it could go lower. So it leads me to my next question to you, which is, let's say for people who, I would venture to guess that the audience we have today is probably a good split between what I'm going to call, which is funny because I'm in this group, OG Bitcoiners, which is class of 2017 and prior, which is crazy to think that, that I'm going to call them OG Bitcoiners. And probably the other half is, class of, we'll say 2019, 2020, 2021 and later. What would your advice be for those people who are, experiencing their first Bitcoin bear market, which happens to be when this is all said and done, is going to likely be one of the bigger ones? How should they handle it? How should they look at managing their money? Of course, this is not individual financial advice, but how should people approach that if this is their first bear market, and specifically in Bitcoin?
Yeah, good thoughts there, and I'll try to touch on all of them. So just first of all, as you said, this is not individual investment advice. I can't give it. This is just for infotainment purposes only, just giving general ideas here. So, and I'm probably wrong. I'm probably wrong all the way across the board. So what do I tell people? You have to decide for yourself what your time frame is. Are you a short-term trader or are you a long-term investor / saver? I would say, based on my opinion and lots of studies, is 99% of people should be long-term saver investors. That's how you should think about things. And Bitcoin is basically the ultimate asset to invest in, or I would say to save in over the long run. So let's go to the first thing. Say you're a trader. You're a short-term trader. Twitter is full of traders. They're all over the place. I go in those rooms all the time and have to talk about views. These are people who draw lines on charts. They're watching the daily price movement. Some of them literally make trades based on minute-to-minute movements in the price of Bitcoin. I always say, just in general, Bitcoin is for saving, not for trading. It's like the equivalent of trading your checking account. Like, it just doesn't even make sense. It's just better money. But it still is volatile. Why is it volatile? Because it's still in price discovery phase. It's going to be volatile for quite a while, at least I would say a decade or more from here. Okay, so we got that out of the way. If you're a short-term trader, clearly Bitcoin is bearish. It's been bearish inarguably since all the way back in basically December of 2021. It's been in this bearish downtrend. It's very strong. It continues to hold. If you're a trader, you should avoid it. Sell it basically. And some people will be aggressive and sell it short. Now, for the other 99% of us, and that should be basically everybody in this room, you got to think from a long-term perspective. What you brought up are very good points. All of the metrics I look at, so I follow on-chain analytics pretty closely. I look at demand-based, adoption-based models for Bitcoin as well, and just basically the S-shaped curve of adoption, which I believe we're at the very early days of that for Bitcoin, for basically being adopted throughout the world over time. Based on those models and using momentum-type indicators, Bitcoin is super, super cheap from a long-term perspective. Now, logically, and I tell people this a lot, quit trying to time tops and bottoms, rather learn to recognize value, learn to see when something is expensive and when something is cheap. I would say that if you have a frame of 5 years, 10 years, which hopefully most people do have, especially with Bitcoin, we're going to look back at this little blip in the price as being an astonishingly good time to be accumulating Bitcoin. So what's it going to do the next 3 to 6 months? I have no idea. I think it's probably going to go a little lower, but I'm just guessing, right? But over the very long run, when we look at this, and if you go back and look at a chart, I think will do extremely well if you're simply accumulating at these levels, not bottom, just accumulating, dollar cost averaging. It's super easy to do. I use Swan for it. I'm not shilling them. I don't get paid by them or anything, but Swan's a good service. You can buy it on Strike. There's lots of other apps you can buy it on. Hey, Coinbits. Yeah, maybe I should check that out. Probably should. I should probably be shilling Coinbits right now, but I don't personally use it, but I would, anybody who's making it easy for people to acquire Bitcoin, I'm a big fan of. So a service you use, this is, I think, a great time to be doing it from a long-term perspective. I do think I'm one of those people based on these demand-based models. By the way, I don't believe in the stock-to-flow model, but I am more of a demand-based guy. I think that probably by the year 2030, so that's now, we're 7 years from there, a little over 7 years. I mean, we're going to be talking about like 7-figure Bitcoin. I think it's probably going to be, as a conservative guess for me, this is just me guessing, I think conservatively it's probably going to be around $1 million by the year 2030. Probably much more than that, but that's, again, just so if that's your viewpoint, if that's my viewpoint, it's kind of crazy to not be accumulating at these levels at prices around $20,000 of Bitcoin. It's hard to deny that's a great time to be buying a fantastic asset. And again, I would argue that Bitcoin is actually the king of assets. I think it's the greatest asset literally that's ever been created. I think the largest opportunity cost in the history of finance and the monetary system is not owning Bitcoin. If you don't own it, I think that's the worst financial decision you could make for the long run. And I'm not even kidding. That's not hyperbole. So that's just how I view it. It's basically what stocks were in the last century, but Bitcoin is, because it's this new financial system and a superior store of value, and because it's perfectly scarce, because it has all of these properties that weren't even possible until the digital age, it's almost laughable to not own it and ridiculous to not own it long run. So hopefully that answered your question. Traders, short term could go down. Long term, I think it's going much, much, much higher. And so these are good levels to be accumulating more.
For sure. And listen, we look at Strike as partners in the mission to get the world on a Bitcoin standard. So if you're listening here and you don't own any Bitcoin, your time to get some Bitcoins now. We think that we have the best service. You guys can check us out, Coinbits.app. But you're welcome to use any DCA service. And I think DCAing is the name of the game here. It's, an old adage is time in the market as opposed to trying to time the market. And so that's the way to do it. And for, like you said, for 99% of people, that should be the viewpoint. And, whatever cash flow you're able to generate, save first. And that's what Bitcoin allows, right? Bitcoin returns people the ability to save. Prior to Bitcoin, it would be very unwise to save. Like the stupidest thing you could do with your money is, keep it in a checking account or a saving account that yields 0.001%, right? That's laughable as inflation is at least targeted at quote unquote 2%, which obviously is also a joke, but you can't save any, in regular cash anymore. And so everybody was kind of forced into investing. And what Bitcoin allows us to do, the regular people who want to focus on their work, on their families, they don't want to have to. Our friend Safe always describes this as having to earn your money twice: once when you do your day job, and then once again to outrun inflation, to keep your purchasing power. That's what Bitcoin allows us to get around. And so if you're saving for the future, if you're saving for 5 years, 10 years out and beyond, you should be saving in the most pristine asset that there is, and that is Bitcoin. And so we're completely aligned on that, Dr. Ross, regardless of what you use to acquire Bitcoin. Make sure you're acquiring some. Time to get off of zero. You're able to cut, a $5 cup of coffee a day and save $25 a week in Bitcoin, and something that you don't have to, hopefully not have to change your lifestyle drastically to be able to do. And we think we have a really good platform to do that. So for those who are just joining, this conversation is recorded. We've been going for about an hour and 10 minutes. I think I got through the majority of the questions that I had. Dr. Ross, do you have any kind of final thoughts for people as we look to close out here?
Sure. Just to reiterate, first of all, this has been a great conversation. Thanks for hosting me. I really appreciate it. And, like I said, I'm not trying to scare people. I really am not. But I just want people to be aware of what's going on out there, to be prepared. This is a time where you can't just, the whole buy and hold with a 60-40 stock bond portfolio strategy. That was great from 2009 to 2021, but we are not in that time period anymore. It's very different now. So when you have a decade of stagflation, we're going to see lots of volatility. We're going to see just huge swings in prices. I think it's very possible that 10 years from now, the price of the stocks that you own in a portfolio are going to be about exactly the same as where they are now, except they're going to have taken you on this freaky roller coaster ride all the way there. And so you have to really think about how to preserve your purchasing power. I would say the easiest way to do that over the long run, and I'm dead serious, I think the easiest way is with Bitcoin. It's just screaming to be bought right now, but nobody wants it, right? This is how it works. It's just like everybody buys insurance when they're scared. Like when they see the fire coming or the floods coming, then they buy insurance. You got to do it when it's cheap. And that's obviously the smartest time to do it is when it's cheap. And Bitcoin is that insurance, and it's offering you a cheap valuation right now. I think stocks are still very expensive. I think bonds they're still not a great investment. I think real estate is going to fall much further in the coming as well. So there aren't very many places to hide. Just be careful. Again, not trying to scare people, but I think if you could have gone into and you could go back in time to 2008 and see what was going to happen to stocks and real estate and things like that, wouldn't you have done things to kind of protect your and your family's purchasing power? For sure you would have, right? You would have just kind of moved to cash maybe and stayed out of those markets. So I just telling people just be aware of what's going on, be smart. And there's a lot of great people on Twitter that are willing to kind of help you with some, I think kind of not individual advice, but just kind of general advice of how to surf these waves. So that'll be my final word, I guess.
Yeah, no, fantastic. And Dr. Jeff Ross, where would you like to hand people off to? Where would you like them to follow your work and see what you're up to and when you switch back to the Dr. Bull?
Yeah, thanks. So, obviously here on Twitter, I'm most active. This is my most active social media platform for sure. I obviously manage money really differently than most other financial planners do and investment advisors. I manage my VailshireCap client accounts kind of like my hedge fund. So we actively hedge. Like right now, we're very short risk assets, and I anticipate we will be for much longer until momentum shifts decidedly. So if you want to learn more about that, you can go ahead and shoot me an email at info@VailshireCap.com, and I'll get back to you personally if that's something you're interested in.
Fantastic. Thank you so much, Dr. Ross. And for those of you who are just joining us or joined us in 11 minutes, this conversation was recorded. We started about an hour and 13 minutes ago now. So if you missed anything, if you want to go back, the recording will be live on Twitter. And take a look at Coinbits as a financial services company, Bitcoin only. We think we have the best DCA product experience out there. Check us out, Coinbits.app. We also have, if you're not ready to commit or if you already got a DCA, method of choice, check out our weekly newsletter. We send out a weekly newsletter that, unless you're on Twitter 24/7 watching news, it becomes a lot to try to keep up with everything that's happening in the financial world and particularly in the Bitcoin world. So we send out a weekly newsletter. The link is in our bio. Go be a subscriber. It's a fun read. Probably the best 5-minute newsletter that you'll receive all week. Check it out. The link to subscribe is in our Twitter handle. So with that, Dr. Jeff Ross, thanks so much for an awesome conversation. There's so many nuggets of information here, so much good wisdom that you shared with people, and we're looking forward to seeing that Twitter handle change to AKA Dr. Bull here, hopefully in the next coming months. So thanks so much for taking the time. Appreciate it.
Yeah, thanks for having me. I'm looking forward to that switch probably more than anybody.
Fantastic. All right, have a great rest of your afternoon. Thanks so much for joining us, everybody.
Thanks, Dr. Jeff.
Thanks, guys.
We hope you've enjoyed this episode of the Bitcoin Roundup podcast presented by Coinbits. So what do you think of the conversation? Share your thoughts with us on Twitter @CoinbitsApp, and be sure to subscribe to be notified of our next episode release. Thanks so much for listening, and we'll catch you next time on the Bitcoin Roundup podcast.